There's a few things I just wanted to cover in terms of like data protection and things like that. So on the discovery call, we are not asking for any specific personalized data. We don't expect clients to outline a lot of detail around their circumstances. I mean, it can help to outline sort of your general basic income level. You don't have to tell us who you work for, but you can maybe give us your occupation, that sort of thing. And these sort of factors aren't necessarily personalized pieces of information, and it's not something that we would use or document or write down or record. So you can be assured of that. Really, the discovery call is generalities, high-level overview, and to get a feel for what your desire is and what your strategy is, and how we can perhaps help you to get to that point. So that hopefully that gives you a little bit of reassurance as well. So another thing I wanted to cover off as well was something that I will often talk about on the discovery call is the two different types of mortgage. And this is very, very important because the approach to these two different types of mortgages can differ drastically. And the requirement and documents needed can also differ as well. So I often mention the two different types of mortgages as being, first of all, a mortgage for your own use or family use, classed as residential. Or the second type of mortgage is a buy-to-let mortgage, where you're buying it with the express intention of renting it out. On the first type of mortgage, which is for your own use or family use, this type of mortgage, lenders and banks tend to go into a deeper dive on your income. They'll also look in detail at your outgoings and what your credit commitments are and what your liabilities are in terms of family. So if you've got dependents, be that children or in fact adult dependents, if for example your spouse doesn't work. So all of these are factors on a residential mortgage where you're buying the property for your own use. The second type is the buy-to-let mortgage, and this is really an amazing facility in the UK because I have quite a number of buy-to-let clients, buy-to-let investors, and their earnings are quite modest. You know, we're talking 50, 60,000 a year. And I'm not just talking about expats. This could be, I've got quite a lot of clients living and working in the UK. They're not expat at all. But they have millions of pounds in borrowing across buy-to-let holdings. And why is that? Well, banks take a very different approach when it comes to affordability for buy-to-let lending because they're looking at the rental yield of the property rather than the individual's earned income. And I will cover this in a different video, but this is where lenders are using what's called an ICR test, and they're making sure that the property effectively is self-funding against the debt that's going to be on it in terms of what the rental income is from the property. And they use a calculation for that. Now, lenders do differ in how they use what calculation they use, but that's essentially why buy-to-let is quite an amazing lending feature. And it's amazing because it can really propel clients to do multiple property purchases several times a year because this is based around the rental yield of the property, not their personal income.